In the Forex market, one of the most fundamental concepts is the exchange rate. This term describes the relationship between two currencies and is essential for understanding how currency trading operates. What is the exchange rate? The exchange rate is the price at which one currency can be exchanged for another. For example, if the exchange rate of USD is 1.1200, it means you need 1.12 US dollars to buy 1 euro. This value reflects the supply and demand relationship between the two currencies and fluctuates constantly due to various economic, political, and social factors. Types of exchange rates. Exchange rates can be classified into different systems. Fixed exchange rate. In this system, the value of a currency is pegged to another currency or a basket of currencies. For example, some countries peg their currency to the US dollar to ensure economic stability. In this case, the central bank intervenes to maintain the value within a specified range. Floating exchange rate. In floating systems, the value of a currency is determined by the market, meaning supply and demand for currencies. Forex operates predominantly under this system, where prices fluctuate continuously in response to factors like interest rates, economic data, and global events. How is the exchange rate determined? Several factors influence the exchange rate, including interest rates. When a country raises its interest rates, its currency tends to strengthen as foreign investors seek higher returns. Inflation. Low inflation typically boosts a currency's value as it retains its purchasing power better. Economic and political stability. Currencies of countries with stable economies and predictable policies are generally stronger. Trade balance. If a country exports more than it imports, its currency appreciates due to high international demand. Exchange rate in Forex. In the Forex market, the exchange rate is presented in the form of currency pairs. For example, in the pair GBP/USD, the exchange rate shows how many US dollars (USD) are required to purchase 1 British pound (GBP). These prices fluctuate every second due to the market's dynamic nature. Additionally, the exchange rate has two prices, the bid price and the ask price. The difference between these two is called the spread, which represents the cost of trading. Why is the exchange rate important? For traders, the exchange rate is crucial as it determines the value of transactions and potential profits or losses. For example, if you buy the pair USD/JPY at an exchange rate of 110.50 and sell it at 110.80, you make a profit based on that change. Conclusion. The exchange rate is the core of the Forex market. Understanding how it works and what factors affect it is essential for any trader aiming to operate efficiently. Knowing the types of exchange rates, whether fixed or floating, will help you interpret the market better and make informed decisions.